Good morning, everybody. Thank you very much for joining us and welcome to the 2023 review and 2024 outlook for Wealth Warriors. My name is Charlie DeLafture. I'm the lead analyst on the Wealth Warriors Fund. With me is Christopher Brownlee. He is our head of research here at High Street. Unfortunately, the fund manager, Ross Beckley, has come down sick, so won't be able to join us this morning. However, Chris and I are well equipped to guide you through a review of 23, as well as how we are looking positioning for 2024. To speak to the format of the presentation quickly, we'll start with just an overview of the fund objective, moving into a review of 2023, both for the market and for the fund. Then leading on to what caused that performance with an attribution analysis for Wealth Warriors, a thematic review within our fund and how we're positioned in terms of our key distinct themes, and then finally a market outlook and how we see ourselves positioned for 24. So the objective of the fund and the mandates is central to all decision making here at High Street, and Wealth Warriors is no different. This mandate has been in place since the fund launched in 2017, and we thought it'd be useful to once again just review what our strategy is and what we aim to do within the Wealth Warriors Fund. So it is our global equity fund. It's US dollar denominated with an offshore focus. It aims to be fully invested at all times, and it invests across developed and select emerging markets. It is more aggressive in nature in terms of its risk profile. So we do recommend a 5-year time horizon and investment period, so investors can ride through market cycles. And then finally, it is exclusively focused on investing in companies which are driving technological innovation and changing consumer behavior. And it does this through a top-down thematic approach. So to give a quick review of markets in 2023, they recovered strongly after the drawdown seen in 2022. So the chart to your left shows sort of the major equity indexes alongside Wealth Warriors. You'll see the performance of all indexes and the fund was very, very different from 22 to 23. To summarize 2022 briefly and the reasons for those dramatic drawdowns, COVID affected us all in a number of ways, and the financial markets were not excluded from that. Lockdowns caused enormous difficulties within supply chains and blockages, which led to rising inflation, which then meant central banks around the world had to use the only tool they had at their disposal, which was the rapid increasing of interest rates to tame the rising prices. This resulted in the US, at least, in the fastest rate hiking cycle in US history. And the subsequent result of that was extremely depressed share prices and dramatic drawdowns. However, despite these prices decreasing, companies continued to operate well. They grew their revenue, they conserved cash, and they continued to increase profitability. It was positive in a sense, despite the sort of being in the middle of the drawdowns in 22, to see that the fundamentals were remaining strong. And it meant that since these drawdowns were macro-based rather than company-specific, the valuations were ready to recover sharply once inflation normalized once more. And that is exactly what we saw in 2023, with a strong recovery as inflation tapered and interest rates looked like they would once more sort of trend back down. Important to note that even though the MSCI World recovered strongly, up 22%, this was primarily driven by the US. Markets in the US were tremendously strong, driven by the Magnificent Seven, which for the S&P alone contributed 60% of returns in 2023. The breadth of the market has been narrowing dramatically given the performance of these shares. In 2020, in 2000s rather, the five largest shares contributed around 18% of the market weight. This is now up at 25. However, we do believe the premiums to be justified, and we will touch on later why we believe that's the case. Speaking to the dollar quickly, the chart on the right-hand side, this is only in 2023, the dollar versus global currencies. It was weaker relative to other developed markets, given the risk on environment. However, it was still stronger versus emerging markets, namely here the Chinese yuan and the rand, as these countries continue to battle with ongoing inflation and employment issues after COVID. So that being said, after 22 and 23, where does Wealth Warriors stand since listing in 2017? And I'm pleased to say that after a difficult year, 2023 largely recovered the losses and is now sitting above its benchmark since inception. It has been an extreme 2 years, and we wanted to touch on that volatility briefly. The COVID-induced lockdowns and the subsequent issues with economies worldwide meant that financial markets haven't seen these kind of conditions, certainly in living memory. To put that into perspective, in 2022, during the drawdowns, value outperformed growth by the second widest margin since records began in the 1970s, according to NASDAQ. That was dramatically reversed in 23, and growth outperformed value by the second largest margin since records began in the 1970s. So we have seen 2 years of quite extreme moves. However, while Wealth Warriors will continue to be more volatile, or likely to be more volatile than a global balance fund, for example, we don't expect this extreme seesawing effect to continue once macroeconomic conditions, once they sort of normalize once more. I think the sort of purpose of saying this is that it pays to remain invested. Crystallizing losses at the end of 2022 would have meant a massive miss on the recovery this year. And just another lesson, I think, that patience rewards the long-term investor. That being said, the 2023, despite the growth, wasn't without its challenges. You only need to look back to March to see the second biggest bank failure in the country, in the US's history. Policymakers, Wall Street, they rushed to prop up the financial system for fear the contagion would spread worldwide. So there will always be reasons to sell, but it pays to remain invested through thick and thin. So looking at Wealth Warriors in particular, where did that 74% return come from? We're pleased to say that it was very broad-based, with only environment as a theme resulting in a negative return. This was down to our single stock within the theme, MP Materials, a rare earths miner, and the largest one in the Western Hemisphere. It was impacted by a falling NdPr, that's the rare earth metals index, which fell sharply due to increased production out from China. However, our remaining 7 themes all added to fund performance, and I think most pleasing was the performance of our top 3 themes, cybersecurity, semiconductors, and big tech, which significantly added to performance between them and rewarded our conviction that was made in 2022. However, despite the strong performance, it is important not just to focus on the success and the successes of 2023, but to look at 2022 and 23 in conjunction. Ultimately, these 2 years are inextricably linked because of the macro environment. Without one, you would not have had the other. Rampant inflation and the aggressive rate hiking cycle caused mass sell-offs, and the tapering of inflation and forward expectation of interest rates led to the strong recovery. So looking at this chart, I think most pleasing is the performance of our highest conviction themes, being cybersecurity and semiconductors. These are the ones that we actively increased in weight during the drawdowns in 2022. We increased cybersecurity from 3% to 16% of the fund, and we increased semiconductors from 8% to 17%. So very active increases in weights there, and very pleased to see our conviction rewarded with strong share price appreciation in 2023. Again, I think once again, it serves a reminder to hold the course, stay invested, look ahead. The market climbs the wall of worry. I'll speak briefly to thematic exposure. However, little has changed from 2022 to 2023. We did rebalance aggressively to take advantage of the oversold market, and therefore it was just a case of sitting on our hands and letting the recovery play out in 2023. The only changes in weights you can see there were due to organic share price growth, and the top three themes, cyber, semis, and big tech, remain our highest conviction ideas. We would like to spend some time now just speaking to and explaining why we are still so bullish on these three themes in particular. So looking first at cybersecurity, there are a number of structural tailwinds that are driving the sector forwards. The chart on your left shows the cost of cybercrime expected in trillions of US dollars. To put some numbers into perspective, because trillion is an enormous and quite incomprehensible number, the current GDP of the US is around 24 trillion. So by 2028, they're expecting, analysts at least at Statista, are expecting almost half of, or over half of US GDP to be lost through cybercrime. The cost of cybercrime is expected to increase by at least 11% annually. Other research houses have it at significantly more. And the cost to individual companies can be enormous. The average hack or cost of a data breach last year in the US was $9.5 million. Essentially, the number and the complexity of attacks is growing rapidly. And this is just going to be, or has been, and will continue to be, further accentuated by the rise of artificial intelligence. JP Morgan just came out the other day saying that they're subject to 45 billion hacking attempts every single day. And it just shows the levels that these companies and governments too need to go to protect themselves from catastrophic damage. On top of that, only 54% of banking CEOs said that they were well prepared for a cyber attack. This is according to KPMG, which does indicate a significant amount of spend is going to come through, or is set to come through in the coming years as governments and companies wake up to the threat. So we can't talk to all our companies within cyber at the moment. We thought we would just highlight our top theme, being CrowdStrike. But we do hold 6 cyber companies across network, cloud protection, and endpoint and threat detection. CrowdStrike operates in the threat detection market using AI and very significant technologies to detect the abnormal behavior of users. The fundamentals speak for themselves, growing revenue 35% in the most recent quarter, extremely profitable profile with gross margins of 78%, and earnings now expected to grow significantly throughout the rest of the year. Analysts currently forecasting 90%. Furthermore, they have great cross-selling ability. Just one metric that the company pulled out from their last results was that customers using 8 or more modules increased by 78% in the quarter. So they have that every single module that you upsell gives you sort of operational leverage and a higher margin profile per customer. So essentially, cybersecurity is a top priority for IT investment. Governments and businesses around the world are waking up to the reality that cybersecurity is a non-negotiable cost of doing business. Cloud computing, it's another sector which is supported by strong market dynamics. It's a field that big tech is dominating. You can see at the chart on your left just how strong the likes of AWS from Amazon, Azure from Microsoft, and Google Cloud from Alphabet are doing in terms of overall cloud infrastructure. While these big tech companies do have a multitude of other businesses, just talking to advertising, hardware, software, to name a few, growth is primarily expected to come from this sector, and so we thought we would focus on that today. One research house expects cloud computing to grow at around 18% per annum for the next 10 odd years. And this is driven by companies adopting advanced technologies like artificial intelligence, machine learning, 5G, and the Internet of Things. What this technology allows companies to do is offer personalized experiences for customers. And this personal connection is something human beings are ever more searching for in an increasingly remote and digitalized world. And you're able to set yourself apart as a business by offering a tailor-made and personal product. Many businesses also looking to move to the private cloud for security reasons, building on the themes spoken to in cybersecurity earlier. So looking at Microsoft, which is our top pick within cloud computing and big tech, Azure, the cloud computing division, has grown dramatically over the last 5 years or so. They only had a 15% market share in 2019. It's now at 24%. Important to note, however, the large majority of these gains haven't come from the other two big tech names that we hold in Amazon and Google. Amazon has lost market share marginally from 33 to 31, and Google Cloud has actually grown their market share from around 7 to now 11. So it's a lot of these legacy vendors, IBM, Oracle, who are losing market share, really unable to compete with the scale and offerings of the big tech companies. So to sort of build on Microsoft, within Azure, growth is expected to remain strong. They do forecast 27% growth for the next quarter. This is only going to be boosted further by AI and developments there. Microsoft has really sort of cemented their leadership in AI through their acquisition of ChatGPT maker OpenAI. And this is already paying dividends despite the acquisition being around a year old. Azure growth last year of 30%. Of that growth, 6% was tied directly to AI products, and this is only expected to increase in the years to come. So Microsoft is currently trading at a valuation that is at a premium to the market. However, we do believe this is extremely justified. If you look at just on their growth alone, it justifies at a 2.3 times PE ratio. However, looking at sort of big tech as a whole and the Magnificent Seven, the fundamentals are enormous, enormously competitive. If you compare them to the overall markets, they're looking to grow their sales at 4 times the rate of the wider markets, and therefore justifies, I think, a slightly elevated premium to your wider market. I'll just hand over to Chris, who can talk us through NVIDIA and the outlook.
So just to speak to our last theme we're going into today, semiconductors, they were the top performing theme in 2023. Semiconductors are the engines of digitalization. They're everything from your fridge to your car, to your cell phone, your computer, to the data centers that are powering the cloud where your data is stored in. And obviously a big story within this theme has been the rise of NVIDIA, which is currently or recently became the 3rd largest company in the world. NVIDIA are famous for inventing the graphics processing unit, or the GPU, in 1999. And initially these GPUs were used for gaming. However, the major breakthrough came when they started being used to accelerate data center servers. And as a result, these GPUs are now the most crucial piece of hardware powering the AI revolution. Just speaking to this AI landscape, NVIDIA currently has a stranglehold on the market for GPUs that are used for generative AI, such as ChatGPT, etc., with around 92% market share. As you can imagine, given the stellar growth we've seen in AI and investment in AI, the demand for NVIDIA's AI chips has absolutely gone through the roof. Just casting your eye to the charts on the left there, this is the shipments of NVIDIA's most advanced chip, the H100. They are releasing a more advanced chip towards the back end of this year. But looking at 2023, you can see that just Meta and Microsoft alone shipped around 300,000 units of these chips. This might not sound like a huge amount, but if you consider that the average one of these chips retails at around $30,000 a pop, there's a very, very significant investment by those companies. This exponential or exceptional demand is expected to continue as AI gains adoption, and NVIDIA currently have a backlog for these most advanced chips of around 2 years. Funnily enough, last year was a very big night for NVIDIA as they reported their Q4 earnings for the last quarter of last year after market closed last night. Given the huge run-up we've seen in NVIDIA's share price both last year and this year, as well as the lofty market expectations, many investors were concerned going into these earnings. However, the company once again posted very, very strong results, comfortably beating expectations, and very positively, it's up around 10% in the aftermarkets. Just to go into these results in brief, they really, really were incredible. The revenue grew over 265% in the fourth quarter. Net income surged 769%, and profit margins are now sitting above 50%. So yeah, just truly incredible results. There was huge anticipation going into this earnings report. It was definitely the most important company earnings release we've had so far this year, as AI growth expectations have been driving the strong performance of the tech sector we've seen this year, which has in turn been driving the broader markets. And NVIDIA is now basically seen as a bellwether for AI and AI investments. Many, however, still believe that AI and its importance to the overall market has been overplayed. However, at High Street, we are of the belief that we are just in the beginning stages of its adoption as a technology, and AI will drive the next leg up for the technology sector in terms of share price performances. This is a view that is supported by some of the most influential people of the century. Just to name one, Alphabet's CEO, Sundar Pichai, came out saying that AI is the most profound technology that humanity is working on, more profound even than fire, electricity, or anything that humanity has done in the past, which is a huge sort of vote of support for this technology. Lastly, much has been spoken about the sustainability of NVIDIA's share price move, and the valuation parallels have even been drawn to Cisco's valuation in the early 2000s. However, we believe it is still attractively valued given its growth. Unbelievably, despite its move in 2023, surged almost 240%, it actually finished the year 30% cheaper on a forward PE multiple, which just speaks to its incredible growth trajectory, which we believe will continue and which we believe justifies a premium multiple. So moving on to the market outlook, as Charlie referred to, the last 2 years in the financial markets have been extremely turbulent. In 2022, to combat the rampant inflation in the market, we saw the most aggressive US rate hikes in history, with the US Fed rate rising from very close to zero to over 4% in 2022 alone. As we know, interest rates are the foundation for valuing all investments right across the risk spectrum. So as you can imagine, these hikes had severe effects on asset prices in 2022. Moving forward a year, encouragingly, US inflation is now moderated, coming down from its peak of around 8.7% to just above 3%, close to the Fed's target of 2%. As a result, interest rates are expected to come down, which should provide a tailwind for equity valuations. However, the timing of these rate cuts will always be uncertain given the inflation trajectory, etc. And just to illustrate this, the market was initially anticipating a cut as early as in March this year, but cut expectations have since been moved to slightly later in this year. So just to carry on this theme of interest rates and their effects on valuations, while interest rates do affect all asset class valuations, higher growth equities are typically affected by a greater degree. This is because a larger part of the value of these companies is placed on cash flows that are further out in the future and hence are discounted for a longer period. Looking at the chart, this is a chart we produced many times, value versus growth. You can see there what is striking. Sorry, just to illustrate, this is value being illustrated by the MSCI World Value Index, and growth being illustrated by the MSCI World Growth Index. You can see that historically, growth has outperformed value quite noticeably. However, you'll also notice that it is a lot more volatile. If you did have to overlay the previous chart on interest rates from the previous slide with the performance of the growth index, it will be highly correlated, with extreme rising rates being a huge headwind for growth assets. As a result, in 2022, as Charlie mentioned, the growth index was down very sharply, down 29%, versus the value index, which was down less than 6% on the back of those extreme rate hikes. However, as has typically been the case, in the ensuing recovery, growth does outperform, as we saw in 2022, with growth producing a 36% return versus value just 8.9%. I think what is most important to note here is, despite the very strong performance of growth assets in 2023, looking at that growth chart, we are basically at the same starting point as we were 2 years ago, which does beg the question, were stocks overvalued 2 years ago or not, and where to from here? In our view, since the fundamentals, or since then, the fundamentals of most of the companies, if not all of the companies we are invest in, has improved notably, with our companies now producing far more revenue and free cash flow than they were 2 years ago, and they have, I suppose, grown into their valuations that they were at the start of that 2-year period. Clearly, these interest rates do have an effect on the equity valuations in the short term. And while interest rates are expected to fall in 2024, which should provide support to these equity valuations, we are ultimately of the belief that it is the company fundamentals that we invest in, such as your competitive advantages, growth prospects, market size, margins, etc., that will ultimately drive the share price performance in the long run. So while we consider the macro interest rates, inflation cycles, etc., our primary focus is on investing in companies with strong, durable fundamentals whose underlying business performance will drive the share price over the long run. Just to drive this point home, as we said, fundamentals is the primary driver of share price performance over longer periods, and Wealth Warriors, our companies, do have superior fundamental metrics. An investor classic is your return on capital. Many believe this to be the strongest indication of companies' competitive advantage. And over the long run, it's very hard for a stock to earn a return in excess of the return that that underlying business earns on its capital. So Wealth Warriors' weighted average return on capital of over 20% is very, very strong, especially versus the indexes, both the MSCI and the S&P 500 index. Then looking at the growth, sales growth is also a large driver of market returns, and Wealth Warriors' sales growth is annualized sales growth expected for the next 5 years of 18% is also very, very strong and dwarfs that of the MSCI and the S&P 500. Then just speaking briefly to balance sheet strength, very strong balance sheets across our holdings with the weighted net debt to EBITDA of under 1 times, again, significantly stronger than the index. I think what's important to mention here is big tech companies in particular have very, very strong balance sheets with large amounts of net cash, which does allow for very strong financial flexibility. I think this is something that's often overlooked. It's incredible the piles of cash these companies are sitting on, and this not only allows them to be opportunistic with acquisitions or growth investments, etc., but also provides a buffer during tough times. Lastly, speaking to net profit margin, very encouraging to see that this growth, while we not only have superior growth, it is also on superior margins, which of course result in greater EPS growth.
So we've given us a summary of Wealth Warriors across 22 and 23. However, we thought it would be remiss not to mention the Wealth Warriors AMC, which we launched at the end of last year, and essentially gives you the Wealth Warriors strategy, but in rands. So the fund strategy is replicated through an actively managed certificate, AMC, which is issued alongside issued by Standard Bank. To give a sort of overview of what AMCs are, they're issued by banks and then managed by a portfolio manager with a specific mandate. So in our case, we are the portfolio manager. The specific mandate is the High Street Wealth Warriors mandate, and the AMC is a mirror image of the High Street Wealth Warriors Fund, except it is valued in rands. Standard Bank is the note issuer. They're quite similar to unit trust in terms of you buy a basket or portfolio of securities, or buy units in a portfolio of securities. With our AMC, it is listed on the JSE and it has daily liquidity. So essentially, these are easy, cost-effective ways to access global companies in rands, and should be a key consideration for anyone looking to get offshore exposure to the world's leading companies, but in a rand-based product. So to summarize, 2023 was a fantastic year for the fund, and it meant that it has now largely recovered from the drawdown experienced in 2022. Performance has been strong so far this year. However, it pays to be somewhat cautious and look towards the long term. And we do that by looking and focusing on fund companies. Chris mentioned the strong operational and fundamental metrics, and we will continue to monitor and analyze these, as these are the key drivers of long-term share price performance. Finally, the messaging, it remains or pays to remain invested, and particularly in those companies driving disruption and technological change. Finally, available in rands through AMC 007. If any investors would like more information on what an AMC is, or particularly the logistics of investing in AMC 007, then please get in touch. I think that's it. Okay, thank you everyone for joining us. As always, if you do have any further questions about Wealth Warriors in particular, the markets, AMCs, please do get in touch. We are always accessible and happy to chat to our investors. Otherwise, yeah, thank you for joining, and keep well.